Imagine your dollar cost averaging into VOO. Confident is the best move for your portfolio. After all, it's the ETF everyone talks about. Simple, well-known, and backed by a solid track record. But what if sticking with this popular VOO strategy is actually holding you back from reaching your real financial goals? Here's the twist. There are 6 lesser-known ETFs that Wall Street professionals use, and some have outperformed the usual picks. One even returned 18% last year compared to SCHD's 12%. If you're curious about why these alternatives could offer more value for your money, you're in the right place. So why does everyone default to VOO? And could following the herd be costing you? Let's break it down. For most investors, VOO feels like the obvious choice. It's everywhere, mentioned in countless blogs, YouTube videos, and by financial experts across the board. The Vanguard S&P 500 ETF is often seen as the benchmark for long-term investing, offering exposure to America's 500 largest companies. The appeal is clear: stability, reliability, growth, and a sense of security that comes from following what worked for millions of others. But popularity doesn't always equal the best fit for your unique financial goals. There's a reason VOO often becomes the automatic answer when someone asks, "What index fund should I buy?" Its reputation is so strong that it's easy to fall into a pattern. If the crowd is doing it, it must be the right move. But investing based on what's familiar can mean missing out on opportunities that are better suited to your needs. The market tends to reward those who look beyond what's comfortable, and sometimes the best results come from exploring alternatives that don't always make the headlines. A closer look at VOO reveals some real barriers. Its share price is around $580, which can be intimidating or even prohibitive for newer investors or those looking to dollar cost average smaller amounts. That high entry point might not seem like a big deal for someone with a large portfolio, but for many, it limits flexibility and makes it harder to build a position over time. There are also other funds that track the same index but offer similar exposure at a much lower share price, making it easier for more investors to participate. Then there's the question of cost. VOO is celebrated for its low expense ratio of 0.03%. That's a strong selling point, but it's not the absolute lowest available. For example, SPLG, another S&P 500 ETF, comes in with an expense ratio of just 0.02%. That 0.01% difference might look trivial at first glance, but over decades of compounding, even a small reduction in fees can translate into hundreds or even thousands of dollars in additional returns. It's a reminder that the little details matter, especially when you're investing for the long haul. Dividend yield is another area where the crowd favorite doesn't always win out. While VOO does provide dividend payouts, some alternative ETFs focus more aggressively on delivering higher yields. Take SCHD, for example, which returned 12% last year, a notable figure compared to other funds in its category. If generating income is a priority for you, it's worth considering funds that are constructed specifically for that purpose, rather than assuming the most popular option will deliver everything you need. Many investors overlook these differences, assuming that the most recognized funds are always the most efficient. But financial professionals and institutions often choose ETFs that better fit their specific strategies, whether that means targeting lower fees, broader diversification, or higher income. They're not just following the crowd. They're looking for tools that align with their goals, sometimes picking funds that fly under the radar but offer real advantages. The reality is that lesser-known ETFs can provide similar or even superior exposure, often with lower costs and greater accessibility. Over time, these subtle differences add up, compounding into meaningful gains that can shape your financial future. By sticking only with the mainstream options, you might be leaving money on the table without even realizing it. Understanding these nuances is key to optimizing your portfolio. It's not about abandoning reliable funds like VOO altogether, but about asking whether there are smarter, more efficient ways to reach your goals. Sometimes the best results come from simply choosing a fund with a slightly lower fee or a more accessible share price, all while maintaining the market exposure you want. If you're open to looking beyond the obvious, you might discover that the best opportunities aren't always the ones everyone is talking about. There are funds out there that offer the same broad market exposure as VOO, but with added benefits that could make a real difference over time. In the next section, we'll explore some of these stealth ETFs, options that might just offer a better foundation for your portfolio without sacrificing the growth or diversification you're after. Let's take a closer look at two broad market ETFs that don't get much attention but offer unique advantages for investors seeking both growth and efficiency. The Schwab US Broad Market ETF, SCHB, and the SPDR Portfolio S&P 500 ETF, SPLG. Starting with SCHB, this fund is built to give you exposure across the entire US stock market. While VOO focuses on 500 large cap companies, SCHB tracks the Dow Jones US Broad Market Index, which covers over 2,400 companies. That means SCHB gives you access to large, mid, and small cap, offering a much wider slice of the market than VOO. This extra layer of diversification can help smooth out the ups and downs of individual sectors and provide more opportunities for growth, especially as small and mid-cap companies can sometimes outperform the giants over certain periods. Accessibility is another key benefit. SCHB trades at around $23 per share, compared to VOO's price of about $580 per share. For investors who are just starting out or who want to dollar cost average with smaller amounts, this lower share price removes a significant barrier. You can build your position gradually without needing to save up for a single expensive share. SCHB's expense ratio is 0.03%, which matches VOO's, so you're not sacrificing cost efficiency. And while SCHB dividend yield sits at 1.27%, the fund's main strength is its broad exposure, giving you a foundation that mirrors the full American market. Now, if you want S&P 500 exposure specifically but at a lower cost, SPLG is worth your attention. SPLG tracks the same 500 companies as VOO, providing virtually identical performance. But the real difference comes in the details. SPLG's expense ratio is 0.02%, making it 33% cheaper than VOO's 0.03%. On a $100,000 investment, that's a $100 savings every year, money that can be reinvested and compounded over time. SPLG's share price is about $69, which, while higher than SCHB, is still much more accessible than VOO. This makes it easier for investors to steadily build their portfolios, especially if they're contributing on a regular schedule. SPLG also offers a slight edge when it comes to income. Its dividend yield is 1.3% versus VOO's 1.27% over the same period. That may not sound like much, but even a small difference in yield can end up over decades of compounding, especially when the underlying performance is nearly identical. For investors who want a bit more income alongside their growth, SPLG quietly outperforms its more famous counterpart. Imagine splitting your investments between SCHB and SPLG instead of putting everything into VOO. You'd get a broader market exposure, more flexibility with how much you can invest at a time, and lower costs that will quietly boost your returns year after year. These advantages aren't just theoretical. They're the exact reasons why some experienced investors and institutions choose these funds, even if they don't get the same spotlight as the big-name ETFs. It's easy to overlook these stealth funds because they don't show up in every headline or recommendation list. But over the long haul, the combination of lower fees, better accessibility, and broad diversification can make a real difference in your results. Every dollar you save on fees or gain through slightly higher dividends is a dollar that keeps working for you, compounding quietly in the background. Broad market ETFs like SCHB and SPLG are a practical starting point for building wealth. They offer a straightforward way to capture the growth of the US economy without unnecessary costs or barriers. Still, while these funds are strong on their own, many investors want to go a step further, adding more income and growth potential to their portfolios. That's where dividend-focused ETFs come into play, offering a different angle on building wealth that goes beyond just tracking the market. When you think about building wealth with ETFs, it's easy to focus on those that simply pay a steady dividend. But there's a group of funds designed to do more, combining the power of income with the power for real long-term growth. These are the so-called dividend dynasties, and two standouts are the iShares Core Dividend Growth ETF, DGRO, and the Fidelity High Dividend ETF, FDVV. Each takes a different approach, but both aim to help you grow your wealth through a blend of rising payouts and strong performance. DGRO is all about dividend growth. Instead of chasing the highest yield today, DGRO invests in companies with a proven record of increasing dividends year after year. Over the past 10 years, DGRO's dividends have grown at an annual rate of 12.53%, surpassing even SCHD's 11.3% growth over the same period. This focus on increasing payouts means your income stream can outpace inflation, steadily growing larger as time goes on. While SCHD might look higher at first glance, DGRO's strategy is to build a foundation that could deliver more total wealth over the long run. DGRO also stands out for its cost efficiency. With an expense ratio of just 0.08%, it keeps more of your money working for you. That low fee structure, combined with broad diversification across more than 400 companies, helps reduce risk while maximizing compounding. Small differences in fees can have a big impact over decades, and DGRO's structure ensures you're not giving up unnecessary returns to costs. FDVV, on the other hand, takes a different path. Most traditional dividend ETFs avoid technology stocks, sticking to sectors like utilities or consumer staples. FDVV flips that script by including high dividend paying tech companies and other growth sectors. This strategy pays off. Over the last 5 years, FDVV has delivered an impressive 18% annual return, well ahead of SCHD's 12.83% in the same period, and it hasn't sacrificed income to get there. FDVV still offers a solid 3% dividend yield. What sets FDVV apart is how it balances growth and income. By tapping into the growth potential of tech and other dynamic industries, FDVV delivers returns that most income-focused funds simply can't match. It holds 122 stocks and keeps costs low with a 0.16% expense ratio. When you combine that with DGRO's 0.08%, it's clear that both funds are built to let compounding work in your favor, rather than letting fees eat away at your gains. The numbers behind these funds tell a compelling story. Over the last 3 years, DGRO has averaged a 9.96% annual return, nearly doubling SCHD's 4.74% in the same stretch. FDVV's tech-driven approach has helped it outperform many traditional dividend ETFs, showing that you can pursue both income and growth without having to pick just one. If your goal is to keep your income rising while also growing your portfolio's total value, these funds offer a practical way to do both. You might wonder whether it makes sense to choose between the two, but the reality is you don't have to. Combining DGRO's focus on dividend growth with FDVV's high return, tech-inclusive strategy gives you a balanced approach. One fund steadily increases your income stream year after year, while the other targets sectors with the potential for market-beating returns, all without sacrificing yield. This combination allows you to address multiple goals at once: income for today, growth for tomorrow, and the flexibility to adapt as your needs change. It's easy to stick with what's familiar when it comes to dividend ETFs, but looking beyond the usual suspects can reveal options that better match your goals. DGRO and FDVV show that you don't have to settle for just one piece of the puzzle. By blending dividend growth and high yield, growth-oriented strategies, You can create a portfolio that's built for both stability and upside. These dividend ETFs create income and growth. Next, we'll look at pure growth funds. Some investors want more than steady income or broad market exposure. They want to aim for the highest growth possible. This is where high growth ETFs like XLK and SCHG come into play. These funds are built for those who want to accelerate their wealth building, focusing on sectors and companies with the strongest potential for outsized returns. They don't just track the entire market. Instead, they target the engines of innovation and expansion. XLK, the Technology Select Sector SPDR Fund, stands out for its performance over the last decade. Over the past 10 years, XLK has delivered an annual return of 19.51%, making it one of the top performing growth ETFs available. Its expense ratio is just 0.08%, so you're not paying a premium for access to this level of growth. XLK's portfolio holds 72 companies, but it's heavily concentrated in tech leaders like Apple, Microsoft, and Nvidia. These three make up a significant portion of the fund, reflecting their dominance in the tech sector and their role in driving market gains. This focus means that when tech thrives, XLK can quickly outpace more diversified funds. That concentration, though, is a double-edged sword. When the tech sector faces volatility, XLK will feel it more than a broader ETF. But for investors who are comfortable with this risk, the potential for high returns is clear. The share price is around $231, which might seem high, but you're getting direct exposure to the companies at the forefront of technology and innovation. For those seeking pure tech growth without paying excessive fees, XLK is a compelling choice. SCHG, the Charles Schwab Large Cap Growth ETF, offers a different take on growth investing. Over the past 13 years, SCHG has posted a 17% annual return, showing steady and reliable performance. Its expense ratio is even lower than XLK's at just 0.04%, and the share price is far more approachable at $27. SCHG's portfolio holds 228 large-cap growth firms, giving you exposure to not only tech, but also consumer discretionary, healthcare, and communication services. You'll still find major names like Apple, Microsoft, Amazon, Nvidia, and Meta, but the broader scope reduces the concentration risk found in sector-specific funds. This diversification makes SCHG less sensitive to swings in any single sector, while still capturing much of the upside from America's fastest-growing companies. For investors who want growth but prefer a smoother ride, SCHG offers a practical solution. You get the chance to participate in market-leading returns without putting all your eggs in one basket. Comparing these two, XLK focuses tightly on 72 top tech names, capturing the explosive growth of the sector, while SCHG spreads your investment across 228 large-cap growth companies for broader risk balance. If you're weighing risk and reward, XLK is the high-octane option that can deliver rapid gains when tech soars, while SCHG provides a steadier journey with exposure to multiple growth engines. Both funds carry higher volatility, especially sector swings in tech, but pairing them can sharpen growth. For example, you might allocate part of your portfolio to XLK for concentrated tech exposure and another part to SCHG for diversified growth. This blend lets you benefit from XLK's potential for outsized returns during tech booms, while SCHG's broader reach helps cushion the impact of any single sector downturn. The result is a strategy that aims to maximize your upside while managing risk across changing market cycles. When you add XLK and SCHG to your toolkit, you open the door to growth that outpaces most traditional index funds. These ETFs can help move your portfolio from average performance to something far more dynamic, especially when combined with income and stability of dividends and broad market funds. The key is not just picking one approach, but using these growth-focused funds as part of a bigger plan that's tailored to your goals and risk tolerance. As you think about possibilities, consider what your portfolio could look like if you stopped following the crowd and started building a strategy that actually works for you. A smart portfolio doesn't rely on popularity. It uses strategy. By allocating 40 to 50% to broad market ETFs for stability, 20 to 30% to dividend growth funds for rising income, and 20 to 30% to growth-oriented ETFs for higher returns, you build a mix that balances risk and opportunity. This approach gives you lower fees, stronger diversification, and the chance to tap into greater long-term gains. Take the time to research these overlooked ETFs and see how they fit into your goals. By making informed choices now, you set up your financial future for success. Comment below which ETF surprised you the most, and subscribe for more insights and strategies.